Welcome, welcome. So it's rare that I break into you guys' day to talk about something like the Fed chair going live. It really is rare, but this is pretty important. A lot of things that we do as investors are tied into what the Fed does. Struggle streaming already, as my man Lead would say. Go on and say it. So it's important to understand what they're doing. The Fed chair had a mm, sit down, let's call it a sit down at the Brookings Institute today. And a lot of things that he talked about at the Institute was kind of what he covered the day, the time before where he addressed the nation at large, but it did not cover some of the nuances to his position. And it's fairly important for us to understand those nuances because they directly affect us as investors. So we should look, we should listen, and we should understand what's going on because that has a trickle down effect to how we make a profit in real estate, especially in the housing market. I want you guys to pay particular interest in the housing when he has his housing market comments. In fact, what I'm going to do is I'm going to play this sound here as a clue for you guys to kind of chime in and listen in to what he's saying because that affects us guys. So when he has when he covers the housing sector, listen for that. Also, some other key points that he's going to make. I'm going to really stop it and address those key points. But guess because it's important that we understand what he's telling us. It's important that we understand these terms. It's important that we understand when you talk about inflation, where he's going, what he's trying to do, because the monetary policy that he established and his group established with respect to interest rates and other is directly affected by his desire to lower interest rate. And then it's also by extension affects us because the interest rate as a rehabber, as a developer, the housing market interest rate, the ability for the average buyer to purchase a house is king. It is king. So it's important that we chime in on that. Let's look, roll the tape, and let's see what the Fed chair has for us for today.
Good afternoon. I'm Glenn Hutchins, co-chair of the Brookings board. And on behalf of our president and some of my fellow trustees who are here in the audience today, it's my great pleasure to welcome all of you, both our post-pandemic in-person audience here, packed house, great to see, as well as our sizable broadcast and online audience. Thank you for joining us today. When President Obama named Jay Powell to the Federal Reserve Board as governor in 2012, no one, including I suspect Jay, expected him to become Fed chair. When President Trump named Jay Powell as the Federal Reserve chairman in 2018, hardly anyone anticipated a global pandemic. And don't forget that then the Fed's challenge was too little, not too much inflation. So Jay Powell has repeatedly been forced to confront the unexpected and had to steer the United States economy through uncharted waters. He's done it with a steady hand, great personal integrity, independence, and an unwavering commitment to the Fed's dual mandate, price stability, and maximum sustainable employment, though I don't think I need to explain any of you that today, despite stiff headwinds, both economic and political. So we're pleased to welcome to the stage today on behalf of the Brookings Institution and the Hutchins Center on Fiscal and Monetary Policy, Jay Powell. Following his remarks, Mr. Powell will field questions from David Wessel, Director of Hutchins Center, and from the audience. Jay, thank you for joining us.
Thank you, Glenn. It's great to be here today. It's great to be back at Brookings. So today I'm going to offer a progress report on the FOMC's efforts to restore price stability to the U.S. economy for the benefit of the American people. And that report must begin by acknowledging the reality that inflation remains far too high. My colleagues and I are acutely aware that high inflation is imposing significant hardship, straining budgets, and shrinking what paychecks will buy. This is especially painful for those least able to meet the higher costs of essentials like food, housing, and transportation. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. We currently estimate that 12-month PCE inflation through October ran at 6.0%. While the October inflation data received so far showed a welcome surprise to the downside, these are a single month's data, which followed upside surprises over the previous 2 months. As Figure 1 makes clear, down months in the data have often been followed by renewed increases. It will take substantially more evidence to give comfort that inflation is actually declining, and by any standard, inflation remains far too high. For purposes of this discussion, I'll focus my comments on core PCE inflation, which omits the food and energy inflation components, which have been lower recently, but can be quite volatile.
All right, let's stop there. It is important that we understand these terms. PCE inflation. Well, what is it? PCE inflation is the personal consumption expenditure price. Okay, so that's the inflation, and the core, like he said, is that he's going to ignore some of the other stuff. So this is what you expend, your personal expenditures. Okay, so PCE inflation. Let's continue on.
Our inflation goal is for total inflation, of course, as food and energy prices matter a great deal for household budgets. But core inflation often gives a more accurate indicator of where overall inflation is heading. 12-month core PCE inflation stands at 5.0% in our October estimate, approximately where it stood last December when policy tightening was in its early stages. Over 2022, core inflation rose a few tenths above 5%. And it fell a few tenths below, but mainly it moved sideways. So when will inflation come down? I could answer this question by pointing to the inflation forecasts of private forecasters or of FOMC participants, which broadly show a significant decline over the next year. But forecasts have been predicting just such a decline for more than a year, while inflation has moved stubbornly sideways. The truth is that the path ahead for inflation remains highly uncertain. For now, let's put aside the forecasts and look instead to the macroeconomic conditions we think we need to see to bring inflation down to 2% over time. For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There's considerable uncertainty about what rate will be sufficient, although there's no doubt that we've made substantial progress, raising our target range for the federal funds rate by 375 basis points since March.
Okay, so we talked about that last time. This dude is committed to trying to do whatever they can do to lower inflation to 2%. And so if you listen to his comments, both last time we covered him, which was about a month or so ago, in fact, what you should do is look at the video that we made of his speech last time and parallel that against what he's doing now. He's laser focused. The Fed is laser focused on reducing overall inflation rate to 2%. And they're going to do whatever monetary policies that are in their power to do to reduce that. So again, listen to that. It's very important because that's going to be the overarching ideology that drives all of his fiscal policies. Let's continue.
As our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting and the summary of economic projections. I will return to policy at the end of my comments, but for now, I'll simply say that we have more ground to cover. We're tightening the stance of policy.
Translation on that is that they're going to raise rate again. You know, it's important that, again, we understand what he's saying. They're raising the rates, guys. And as investors, we have to bake that stuff in. So let's continue on.
In order to slow growth in aggregate demand. Slowing demand growth should allow supply to catch up with demand and restore the balance that will yield stable prices over time. Restoring that balance is likely to require a sustained period of below-trend growth. Last year, the ongoing reopening of the economy boosted real GDP growth to a very strong 5.7%. This year, GDP was roughly flat through the first 3 quarters, and indicators point to modest growth this quarter, which seems likely to bring the year in with very modest growth overall. Several Russia's war against Ukraine and our policy actions, which tightened financial conditions and are affecting economic activity, particularly in interest-sensitive sectors such as housing. So we can say that demand growth has slowed, and we expect that this growth will need to remain at a slower pace for a sustained period. Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it's useful to break core inflation into 3 component categories: core goods inflation, housing services inflation, and inflation in core services other than housing. Core goods inflation has moved down from very high levels over the course of 2022, while housing services inflation has risen rapidly. Inflation in core services ex-housing has fluctuated, but shown no clear trend. And I'll discuss each of these items in turn. Early in the pandemic, goods prices began rising rapidly as abnormally strong demand was met by pandemic-hampered supply. Reports from businesses and many indicators suggest that supply chain issues are now easing. Both fuel and non-fuel import prices have fallen in recent months, and indicators of prices paid by manufacturers have moved down. While 12-month core goods inflation remains elevated at 4.6%, it has fallen nearly 3 percentage points from earlier this year. It is far too early to declare goods inflation vanquished, but if current trends continue, goods prices should begin to exert downward pressure on overall inflation in coming months. Housing services inflation measures the rise in the price of all rents and the rise in the rental equivalent cost of owner-occupied housing. Unlike goods inflation, housing services inflation has continued to rise and now stands at 7.1% over the past 12 months. Housing inflation tends to lag other prices around inflation turning points, however, because of the slow rate at which the stock of rental leases turns over. The market rate on new leases is a timelier indicator of where overall housing will go over the next year or so. Measures of 12-month inflation in new leases rose to nearly 20% during the pandemic, but have been falling sharply since about mid-year. As Figure 3 shows, however, overall housing services inflation has continued to rise as existing leases turn over and jump in price to catch up with the higher level of rents for new leases. And this is likely to continue well into next year. But as long as
All right, so let's unpack that. Rental rates are not looking good. They're still too high in quarter the Fed chair's estimation. And as he said, that's not going to change no time soon, well into the next year, as he said. Now, what does that mean for us? What does it mean for investors? Well, it means that now we may have to shift our business model from a rehab and rapidly resell business model to a buy and hold business model. If we know that rentals rates are going to maintain or increase over the short term, there's an opportunity to take advantages of that. So Fed Chair already said that. Now, their stated goals to drop everything to 2%. They are committed to doing that, but then also just specifically in the housing market, they see that that goal is going to be more difficult than other markets. The housing market is pretty stubborn. As investors, that's an opportunity. Now you got to buy right, and we have a video talking about how to buy a home. I'm going to update that video to talk about how to buy a home in today's market, because the market is shifting, and the market will continue to shift according to the Fed. You just said it, for it's not going to have a turnaround until sometime next year, most likely, second, third quarter, if then. So we have an opportunity. We have a window, guys. But you got to be smart. You got to buy right, and you got to think about how we're going to handle this inflation situation. Let's continue on.
New lease inflation keeps falling, we would expect housing services inflation to begin falling sometime next year. Indeed, a decline in this kind of inflation underlies most forecasts of declining inflation. Finally, we come to core services other than housing, and this spending category covers a wide range of services, from healthcare and education to haircuts and hospitality. This is the largest of our three categories, constituting more than half the core PCE index. Thus, this may be the most important category for understanding the future evolution of core inflation. Because wages make up the largest cost in delivering these services, the labor market holds the key to understanding inflation in this category. In the labor market, demand for workers far exceeds the supply of available workers, and nominal wages have been growing at a pace well above what would be consistent with 2% inflation over time. Thus, another condition we're looking for is the restoration of balance between supply and demand in the labor market. Signs of elevated labor market tightness emerged suddenly in mid-2021. The unemployment rate at the time was much higher than the 3.5% that had prevailed without major signs of tightness before the pandemic. Employment was still millions below its level on the eve of the pandemic. Looking back, we can see that a significant and persistent labor supply shortfall opened up during the pandemic, a shortfall that appears unlikely to fully close anytime soon. Comparing the current labor force with the Congressional Budget Office's pre-pandemic forecast of labor force growth reveals a current labor force shortfall of roughly 3.5 million people. This shortfall reflects both lower than expected population growth and a lower labor force participation rate. Participation dropped sharply at the onset of the pandemic because of many factors, including sickness, caregiving, and fear of infection. Many forecasters expected that participation would move back up fairly quickly as the pandemic faded. And for workers in their prime working years, it mostly has. Overall participation, however, remains well below pre-pandemic trends. Some of the participation gap reflects workers who are still out of the labor force because they're sick with COVID-19, or continue to suffer lingering symptoms from previous COVID infections or long COVID. But recent research by Fed economists finds that the participation gap is now mostly due to excess retirements, that is, retirements in excess of what would have been expected from population aging alone. These excess retirements might now account for more than 2 million of the 3.5 million person shortfall in the labor force. What explains these excess retirements? So health issues have surely played a role, as COVID has posed a particularly large threat to the lives and health of the elderly. In addition, many older workers lost their jobs in the early stages of the pandemic when layoffs were historically high. The cost of finding new employment may have appeared particularly large for these workers, given pandemic-related disruptions to the work environment and health concerns. Also, gains in the stock market and rising house prices in the first 2 years of the pandemic contributed to an increase in wealth that likely facilitated early retirement for some people.
All right, so stock market. It is true that some people decided to retire early, live off their stocks. And there has been a recent I wouldn't say crash, but it's fair to say a correction in the stock market. We're going to pull up the stock market a little bit later on to see how it responded to the Fed chair and other economic news. There's been some very positive reports out today, and I would guess that the stock market has responded positively. However, you got to take everything in totality. You got to take what he's saying, the other reports, and the fact that a lot of people, as the Fed chair said, decided that they're going to just live off of their stocks. Everything is interconnected and related. And as investors, as the master of your household, if you're thinking about investing in the market, you need to know or have a general understanding of how all these parts fit together. Let's continue on.
The data so far do not suggest that excess retirements are likely to unwind because of retirees returning to the labor force. Older workers are still retiring at higher rates, and retirees do not appear to be returning to the labor force in sufficient numbers to meaningfully reduce the total number of excess retirees. So, the second factor contributing to the labor supply shortfall is slower growth in the working age population. The combination of a plunge in net immigration and a surge in deaths during the pandemic probably accounts for about 1.5 million missing workers. Policies to support labor supply are not the domain of the Fed. Our tools work principally on demand. And without advocating any particular policy, however, I will say that policy to support labor force participation could, over time, bring benefits to the workers who join the labor force and support overall economic growth. Such policies would take time to implement and have their effects. For the near term, a moderation of labor demand growth will be required to restore balance to the labor market.
All right, so let's take a look at the stocks, guys. He mentioned how stocks is playing an effect on retirees and people re-entering into the labor force. Well, let's take a look at it. We're going to add and see what happened in the market for today, how the market responded to the chair's comments and other good economic data. Let me add this to the stream, and I'm going to make it full screen so we can zoom in on this. Let me close this out and see if we can expand that. Can you guys see that? So let's see if we can. So I'm looking at the open market, and then also you can see that after hours was very positive. Basically, if it has green on it, you made some money. So the Dow was up plus 751 or 2.22% today. S&P 3.17 and NASDAQ 4.63. So a really, really good market, really good day today. And it has recovered for the day. I think that it was last couple of days the stock market has been a little depressed. But let's look at some of the big stuff, some of the big stocks that I want to cover. Zoom in here. Okay. It looks like got a lot of ads popping up here, but let's go and look at how what I call the A stocks, the prime stocks, and gives me indication of where we are in the market. With the blue chip stocks, the well-known names. Let's see how they did. today. We have Bitcoin. Bitcoin is up today, $156 or so, or 0.92%. So Bitcoin is up. I'm sure you guys have heard about Microsoft. Let's see where they are today. And I'm looking on Robinhood, guys. It's a great app. Let's see. We have Tesla. Tesla is up today, during the normal trading session, 7.70%. And after hours, we're looking at basically flat, 0.05%. So that's Tesla is up. Disney, another well-known brand, that's up today, 3.35. After hours is another 0.01. So they're up over 3% today, 3.35 as mentioned. We have Apple. Apple was up today 4.85%. After hours, it gave a little bit back, 0.12, but it ended the day up again, 4.85. Meta, Facebook, that is up fairly decent today, almost 8%, 7.94. After hours, it gave a little back, 0.14, but again, 7.94 during normal trading. Microsoft up today 6.17%. So Microsoft is up. And then Google was up another 6%. So Google is up 6.3%. So if you are investing in blue chip stock, you had a good day. You had a good day, and I would have to think that the market responds to this type of data. It responds to comments that the Fed chair is making, and it extrapolates those comments and say, well, is it a good bet to bet on these things, these other stocks, or is it not? How would the market look in the near term? How would the market look in the far term? What are the Fed's monetary policies? So I think that a lot of things come into how the market responds. In a way, it's really like a living person. It takes all this information in, and based on the information of the day, it responds. So let's go back to what the Fed chair said and continue on.
Currently, the unemployment rate is at 3.7%, near 50-year lows, and job openings exceed available workers by about 4 million. That is about 1.7 job openings for every person looking for work. So far, we've seen only tentative signs of a moderation in labor demand. With slower GDP growth this year, job gains have stepped down from more than 450,000 per month over the first 7 months of the year to about 290,000 per month over the past 3 months. But this job growth remains far in excess of the pace needed to accommodate population growth over time, about 100,000 per month by many estimates. Job openings have now fallen by about 1.5 million this year, but remain higher than at any time before the pandemic. Wage growth, too, shows only tentative signs of returning to balance. Some measures of wage growth have ticked down recently, but the declines are very modest so far relative to earlier increases and still leave wage growth well above levels consistent with 2% inflation over time. To be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent with 2% inflation. So let's then sum up this review of economic conditions that we think we need to see to bring inflation down to 2%. Growth in economic activity has slowed to well below its longer run trend, and this needs to be sustained. Bottlenecks in goods production are easing, and goods price inflation appears to be easing as well, and this too must continue. Housing services inflation will probably keep rising well into next year, but if inflation on new leases continues to fall, we will likely see housing services inflation begin to fall later next year.
Housing services inflation, housing inflation. Again, as investors, that directly affects us, and especially real estate investors or anyone who plays in the real estate market, whether you are a buy and hold person and you're just renting out, or you are a person that is building and ultimately want to sell the property, or some mixture in between. Guys, the rate is going to increase. You know, we have a house here that we just finished up and we're purchasing another project for next month. You can still do it. You can still find good deals out there for investors, but you got to buy right. Another thing that he mentioned that is important, and I don't want us to gloss over that, is the supply chain. Back in the height of the market, the supply chain was really bad, and that actually drove up prices. I saw another report that the House, congratulations to the House, they passed a rail bill so that it wouldn't shut down the mass transit system, the rail system, and that's great. It was passed bipartisan vote. I think that, of course, until the new House comes in, it's still controlled by the Democrats, but you had almost 80 Republicans, sign on to the bill. So congratulations. It's great to find common ground. In fact, I'm going to do a whole show on potential common ground for the Congress, especially the House, because the Republicans are going to be in charge coming this next session, and they will have to work with a Democratic-controlled Senate and a president that is a Democratic President Biden. So we're going to have to work together, guys. We really do. So if we can find common ground, if we can find bills that make sense, that keep America going, that both parties can kind of agree with, sure, they're not going to agree with everything, but there's enough meat there to where both parties can agree and have put something out there that will increase the productivity of America, help out the GDP, help out us, the people that's in the housing market, the people that buys groceries, the people that buys home supplies. We got to get those supplies to the Home Depots of the world, where we can then purchase it and put into a house. And if it costs more money to get the product there, it's going to cost more money for us to build or renovate a home or a development. So passing bills like that make sense is important. And I'm so pleased to hear that the Republicans joined the Democrats in this particular bill so that we can avoid that shutdown. So let's continue on.
Finally, the labor market, which is especially important for inflation in core services ex housing, again accounting for more than half of the category, shows only tentative signs of rebalancing, and wage growth remains well above levels that would be consistent with 2% inflation over time. So despite some promising developments, we have a long way to go in restoring price stability. Returning to monetary policy, my FOMC colleagues and I are strongly committed to restoring price stability. After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time. Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation.
He's making it clear. They're going to raise the rate again when they meet the next time, and as soon as December. So we should not have we shouldn't be shocked by it. We should not. It takes roughly 4 months, 5 months, 6 months or so from start to finish to build a property or to rehab a property. Let's say anywhere between 3 months to, on average, 6 months, 7 months to rehab a property. If we know that the rates are going to be is going to increase, which he just said is going to increase, well, we got to think about that. We got to think ahead. If you are exposed, and if you think that you are counting on a market that is easier for a buyer to buy a home, or a market that your price relies upon a certain condition of the market, and that condition of the market does not include increased rates, then you're going to be out there, man. You're going to be out there. You cannot expect that these rates are going to drop no time soon. You got to plan for it. The brother right here is saying, hey, listen, we're going to raise the rates. It's not if we're going to raise the rates, is how much we're going to raise the rates. Important for us to think about that as we move forward. Let's continue on and see what else he has to say.
Inflation and the length of time it will be necessary to hold policy at a restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy, and I'll close by saying that we will stay the course until the job is done. Thank you.
Stay the course until the job is done. This dude is resolute. He's going to try to do whatever he can do to get inflation down to 2%, which means that overall inflation. So housing inflation is going to still be a little bit elevated. It's unlikely that it's going to get down to 2% no time soon. And he's willing to take the heat to get it there. So if you listen to his speech and play this tape back and listen again, count how many times he said inflation 2%, inflation 2%, inflation 2%. Now he's going to have a sit down and he's going to field some questions, but that is the bedrock of their policy, is that what can we do to get that inflation down to 2%? I don't know how many times that the brother can say it. We just got to listen to him and take him for his word. Let's add him back. Let's see what we got here.
Thank you very much, Chair Powell. I think you spared me the chore of asking you to pick between 50 and 75, so I won't have to ask you that. Thank you for your last paragraph. But I want to talk a little bit about wages and inflation. So, as you said, wages are rising faster than is consistent with a 2% inflation rate, assuming reasonable productivity. You said in November that wages are not the principal cause of prices going up. But for many workers, real wages have been falling lately. So I wonder, isn't there room for wages to rise a bit faster so workers can make up lost ground? And what level of wage increases do you think is consistent with a 2% inflation target?
Okay, so I guess I would start by saying that the inflation that we saw at the beginning of this episode back in March of 21 was not really related to wages at all. It was related to tightness in goods markets, largely due to supply chain issues. Over time, though, inflation has now spread broadly through the economy. And while I would still say that the inflation we're seeing now is not principally related to wages, we think that wage increases are probably going to be a very important part of the story going forward, particularly as it relates to that third category of core services ex housing. So we think it is an important thing going forward. And ultimately, in the service sector in particular, where wages and benefits are by far the largest cost, wages need to go up. And of course, we want wages to go up. We want wages to go up strongly, but they've got to go up at a level that is consistent with 2% inflation over time, making basic assumptions about productivity. So if you look at the principal wage measures that we look at, I would say that you're 1.5 or 2% above that with current wage increases. So particularly the employment compensation index and the average hourly earnings index. Look at those two. It's about 1.5% higher than what would be consistent, making various adjustments, including for productivity from nominal wages. So, as we look at the labor market today, including today's JOLTS data, what you see is a labor market that there's a real imbalance between supply and demand. There are 1.7 job openings for every unemployed worker, everyone looking for a job. The so-called jobs workers gap is about 4 million, meaning if you look at all of the available jobs, including people who are working, and then look at people who are in the labor force or are looking for a job, there's a 4 million shortfall. So you're in that world, and we think that there's a job for moderating demand in there and getting the labor force back into balance.
You don't think that there's a possibility that we should have a period of catch-up of wage increases above the sustainable level, and that businesses with relatively fat profit margins can absorb some of that without passing it through?
So that's the question of the worker share of profits and that kind of thing is not really related to this. Right now, people's wages are being eaten up by inflation. So what you want to do is you want to have inflation stable and then have a very strong labor market where the biggest wage gains are going to the people at the bottom end of the spectrum. And we had that at the end of the very long expansion that ended with the pandemic. That's not what we have now. Now, for most workers, the increases they're getting in wages are being eaten up by inflation. That's actually not true at the bottom end, where wage increases are higher than inflation. And that's a good thing. But if you want to have sustainable, strong labor market where real wages are going up right across the wage spectrum, especially for people at the lower end, you got to have price stability. And until we restore that, we can't get back to that place where we kind of were for the 2 years before the pandemic hit.
And did you take, when you looked at today's JOLTS data, which measures the vacancies and quit rates, did you find that encouraging?
More or less in line with expectations, but that's
going the right direction.
That's a good thing, right? So yeah, I guess job openings came down by several 100,000 to where they are now, and yeah, that's a positive thing. As you know, the relationship between job openings and unemployment is a very fraught one, and job openings right now compared to unemployment are at near their all-time high levels. So it has been our view that there's a possibility that in this highly unusual situation in the labor market could come back into balance to some extent through a decline in job openings, and that there's been a typical relationship between increasing unemployment and declining job openings, but that our thinking has been, and many labor economists share this, that you could get a decline in job openings that wouldn't produce the same increase a smaller increase in unemployment than is typically the case looking back in history because of the very outsized level of job openings. And we've kind of seen that so far, but it's way too early to say that'll work.
Traditionally, the Fed looked at the unemployment rate as a measure of labor market tightness, and we've seen recently that may be misleading. Unemployment rate is still very low, and as you pointed out, job vacancies is starting to come down. But to the extent that the Fed still relies on a Phillips curve kind of relationship, going forward, is the natural rate of unemployment a useless concept? What measures will the Fed use to judge labor market slack as we look ahead to policy in the coming years?
I think the way we think about it, of course, the standard way to think about it is it's the gap between the actual unemployment rate and the natural rate of unemployment that matters, right? And the issue really, it's not that framework doesn't make sense. It does make sense. But the issue is that the natural rate of unemployment is very hard to identify with certainty, even in normal calm times. But when there's a violent disruption of the labor market, it can move very substantially. So, and that happened at the beginning of the pandemic. You had the labor market was very much disrupted, and we assumed that the natural rate had moved up, meaning that for any level of unemployment, the labor market is tighter. So we knew that. And I think what was different in this cycle was really that you had to look at things like job openings and quits and reservation wages and just wages overall to tell you that the natural rate of unemployment had really moved up quite a lot. But I don't think it's a problem with the framework, but it is a fact, though, that it's very hard to pin down where the natural rate of unemployment might be when there's this massive disruption in the labor market going on.
So do you think that the JOLT state of the job vacancies per unemployed worker, that's going to be a lasting measure of labor market tightness for you at the Fed?
Yes, I think people will tend to look at it.
Well, when you tell them you're looking at it, they tend to look at it.
They'll look at it.
I've noticed that.
That's right. I would just say in this particular situation, we think it's important, and we're going to find out empirically whether that was true for the reasons I explained. We think that we can see a big decline in job openings and less than you would expect of an increase in unemployment. So this was a unique in so many different ways.
Right.
This series of events was different from one in particular is just that so much of the inflation was due to supply side constraints,
right,
which is not a feature of the U.S. economy for a long time.
Well, but Vice Chair Lael Brainerd said the other day in a speech that she raised the question of whether long-term changes of the economy, like labor supply, deglobalization, climate change, could reduce the elasticity of supply, and that this may be a problem going forward. Do you share that?
So this is a great set of questions that we've all been thinking about a lot, and Lael's speech was really terrific on that. Augustin Carstens has given a couple of speeches on the same topic, including one at Jackson Hole this year.
The head of the Bank for International Settlements.
Yes, exactly. The question is, is the new normal going to be unlike this normal that we've had where supply side disruptions and constraints were relatively, you could look through them. The lore has been for a long time that you don't need to worry about that. It'll sort itself out. A supply shock from oil prices or whatever. Are we going into a situation a little bit like the 70s where there will be ongoing repeat shocks, and which would tend to put more upward pressure on inflation over time? We don't really know. It's a great question. But the question, I guess the real question is, if that's true, what are the implications? We still have a 2% inflation target, and we still have to use our tools to achieve it and to keep inflation expectations anchored. But it's very hard to know. It's very hard to know the answers to these things. We tend to assume things will go back to the way they were, just naturally, but that doesn't seem to be happening so far.
Right. Now you mentioned in your remarks that forecasts of inflation have, not only those at the Board of Governors, but in the private sector as well, have been lousy. Inflation has not behaved the way the forecaster said. So I wonder how you think about using forecasts of inflation and making policy. If you can't tell us, or if your staff can't tell you with some degree of confidence what inflation is going to be 6, 12, 18, 24 months out, how do you think about that in deciding when you make policy decisions?
So I'll say that it is very difficult to forecast inflation now, and one of the reasons is just that the situation is so different from the normal one. And as I mentioned, a lot of it is just that the difficulty is just these supply side constraints that we've had. We had no experience in forecasting that. It was this was a case of first impression. So that was very difficult. Nonetheless, we do make forecasts. We'll continue to make forecasts. The way I tried to get around that in my remarks was to say, let's put the forecasts aside for a second and let's try to identify the macroeconomic conditions that we think we need to see that would put downward pressure on inflation. So that's a way to think about it. We'll continue to make forecasts, but we're going to have to be humble and skeptical about forecasts, I think, for some time. And that calls for a lot of risk management. And the other difficulty, of course, is that monetary policy works with long and variable lags, and particularly inflation is at the end of that train. And so if you're waiting for actual evidence that inflation is coming down, it's very difficult not to over tighten if that's all you're doing. So we have a risk management balance to strike, and we think that slowing down at this point is a good way to balance the risks of
slowing down on the pace of rate
hikes.
I see. But it's still a problem if you can't use today's economic conditions that you think are likely to generate more or less inflation. Is that basically?
Well, first of all, I'm agreeing that it's a very difficult situation in which to forecast inflation, and really very few professional forecasters have gotten it right. So I think we'll look at various things. We'll look at our forecasts. We'll look at the actual data. We'll look at, I gave you the three pieces and the elements of those three pieces of core inflation that we're looking at. We will, look at these macroeconomic conditions where, for example, we will try to identify a level of a stance of policy that's sufficiently restrictive to bring inflation down. You can't identify that with great precision and confidence, but we'll look at the changes in financial conditions and the effects that those financial condition changes are having on the real economy. We'll look at all of those things and make a judgment, and it'll have to be judgment as to what that is.
Well, when you think you've talked frequently about the need to have policy restrictive, and that often is used as the definition of restrictive is above some neutral rate of interest, the one that will prevail when all is calm. And you gave a speech at Jackson Hole a number of years ago pointing out how identifying all these things, the natural rate of unemployment, the natural rate of interest, the problem is that we don't know what they are. So how will you know when policy is restrictive? How do you think about what the neutral rate is under the current conditions of the economy?
The answer to that is that there isn't any one perfect summary statistic. So the way I think about it, and I think the way we generally think about it is, we make our policy changes and they affect financial conditions. Actually, it works the other way around. Financial conditions tighten in expectation now, different from what it used to be. So they tighten. And so we monitor the tightening of financial conditions. We look at the history of these financial conditions index, and we ask how tight are financial conditions. We also look at the effect that tighter financial conditions are having on the real economy, particularly now interest-sensitive spending, but also other things as conditions tighten. We also look. So, what are the financial conditions we look at? We'll look at the entire rate curve. If you think about risk-free, the Treasury rate curve, we'll look to see significantly positive real rates across the curve. And you have that. You can argue about the short end, but you've got to pick some sort of a forward-looking reading for inflation. And I think inflation compensation in the markets definitely reflects confidence in us bringing down inflation. So you've got real rates really across the whole yield curve. You also look, though, at credit spreads and what are private companies borrowing at, because most borrowing doesn't happen at the federal funds rate. It happens in many other places. We look at asset prices. We look at exchange rates, which are just another asset price. We look at all those things, and we try to make a judgment about whether put some weight on the real interest rate curve, some weight on the other aspects I talked about. I think you have to make a judgment at the end, though, that you're restrictive.
So an estimate of the neutral rate of interest didn't seem to be one of the big factors in that list you gave?
No, it's in there. It's in there in looking at the real rate curve. So you'd look at the real rate curve. You'd want real rates to be above what we'd estimate as the longer run neutral rate. Mm-hmm. The issue is, the longer run neutral rate is a rate at a time of full employment and 2% inflation and the economy in perfect equilibrium. That isn't where we are.
Yeah, I noticed. Can I turn to the balance sheet for a minute? I'm going to turn to questions from the audience in a minute. What criteria are you going to use to decide when to end the shrinking of the balance sheet? Is it the economy? Is it whether money markets are functioning well? Is it whether the Treasury is having trouble raising money? How do you decide when you've shrunk enough, when you should end the shrinking?
So I should refer you to a document that lays all this out in detail that I really should be reading to you, but I'll paraphrase it.
Thank you.
If I don't get it exactly right. Yeah.
No one will pay attention if you don't get it exactly right. Don't worry about it.
Pretty much wing it.
Relax.
So we're in an ample reserves regime. And what that means is that changes in the reserve level will generally not affect the federal funds rate. So there's more than enough reserves in the system. So we're not close to reserve scarcity. So what we've said is that we would allow reserves to decline until we're somewhat above the level that we think is consistent with an ample with scarcity.
Right.
And then for a while, what you do is you hold the balance sheet constant, and non-reserve liabilities grow while reserves shrink. So we sort of shrink gradually down to that. And then at a certain point, we're just going to call it. We're not looking to really go back into proving that they're scarce, because what happens is, and you saw this back a few years, the demand for reserves is not stable, and it can move up and down very substantially. So we want to stop at a place that's safe. You know, having a lot of reserves in the system is really a good thing. It's really a public benefit to have plenty of reserves, plenty of liquidity in the markets and in the banking system, the financial system generally. So that's how we would do it.
In the minutes of the last FOMC meeting, it said the staff had a forecast that it forecasts below potential growth, but not a recession. But then there was this interesting sentence where the staff said the possibility that the economy would enter a recession sometime over the next year is almost as likely as their baseline forecast. Is that how you look at it?
So I have resisted the temptation to handicap it.
Go on.
I think I'll continue to do that. But I get the way I think about it is I do continue to believe that there's a path to a soft or softish landing. I do believe that, and
the definition of a softish landing is what?
Soft.
Unemployment goes up a little, but we don't have a recession.
Yeah, unemployment goes up, but it's not a hard landing. It's not a severe recession. You know, you could think of unemployment going up, but not really spiking as it does in some recessions. So that's how I think about it, and I think the path is pretty clear. The labor market conditions soften. We see inflation, and the goods inflation gets better, housing services inflation gets better, and the labor market softens but doesn't go into recession, and you see inflation start to come down. And I mean, I think that's very plausible. I don't want to be the handicapper on it, and of course, our job is to try to achieve that, and I think it's still achievable. Although, if you look at the history, it's not a likely outcome, but I would just say this is a different set of circumstances.
So you said at the last press conference that you thought the path to that soft landing had narrowed. Has it continued to narrow, or is it widened? Or I don't know if you can have a wider soft landing, but
I don't know that it's changed since this is what, 5-6 weeks ago.
Yeah.
I was asked the question, has it narrowed? Is it still possible? And has it narrowed? It's definitely still possible. And it has narrowed because if you look over the course of this year, nobody expected us to raise rates this much. No one expected inflation to be this strong and this persistent and this, to have spread so broadly through the economy. And so the extent we need to keep rates higher or keep them higher longer, that's going to narrow the path to a soft landing. On the other hand, if we get good inflation data and we get evidence that all the things that I talked about, if all those things start to swing the other way, then we could very much achieve this.
In August 2020, you announced a new framework for monetary policy, the flexible average inflation targeting framework. And I wonder whether there's anything in that you think we should be rethinking now in light of the recent experience.
We said we would do another framework review in 5 years. And so that would be to bear fruit in 25 or 26. So that's what we're going to do. We're going to stick to that. I think we need to see this through a full cycle. We need to see the other side of inflation and what the economy looks like after this historic episode to really make good judgments about that. I will say, though, that aside from the framework itself, we implemented it through guidance of various kinds. And we put in really strong guidance because there were a lot of doubters that we would ever achieve 2% inflation, if you remember. That was the main criticism. Little did we know. But one piece of guidance that we gave was, and I don't think this had anything to do with or much to do, let's say it that way. It didn't have much to do with all this inflation we're experiencing. But the one piece of guidance that we gave that I probably wouldn't do again was we said we wouldn't lift off until we saw both maximum employment and price stability. And I don't think I would do that again.
Because
I think it limited it's the tail risk. We tend as human beings to underestimate tail risk, and I think we didn't think. It seemed so unlikely. If you remember, 25 years of low inflation,
right,
and many years after the pandemic, after the global financial crisis of inflation everywhere in the world, it's all disinflation. Just didn't seem likely, and yet here we are.
So it turns out that when you invite the chairman of the Federal Reserve to speak at Brookings, a lot of people email you questions. Most of them are questions I've already asked or questions that were so poorly framed that I couldn't even understand the question. But somebody asked me this one, and so I want to
because they are able to buy the home cash. So this is a great opportunity for most investors. Again, we want to talk about their overarching goal, which is 2% inflation. As I said, the housing market, I just noticed that my sound was out, so I'm going to recap real quick. The housing market, we know that the housing market is a little stubborn. Let's just say it that way. The interest rate in the near term and sometime in 2023, as the Fed chair said, it's going to probably be high. But the good news is, if you are investor that is a buy and hold, and you have a lot of rental properties, the rental market is going to still be very strong. I want to point out that these opinions of mine are just that, they are opinions. By no means should you should consult. You should consult with your team, your financial advisor, and take all of this information in totality as you strategize your next move. But based on what the Fed chair and my interpretation of the Fed chair is saying, is that these are the conditions for the near future, as well as, let's say, second, third quarter of next year. Now, he talked about the unemployment. Basically, he said that it's the market conditions support a much less unemployment, and he gave some factors of why he thinks the unemployment is artificially high. Now, when he got to recession, though, he really, you heard comments about soft landing, and they don't really think, and if the conditions change and inflation goes down and that type of thing, he was really kind of backing away. He talked more about a soft labor force, really more than anything else, as a contributory factor. But everything, I have to go back to this 2% inflation goal. Everything that he discussed was couched in their desire to get us to that 2% inflation goal. So what do you do from here? If you're in the housing market and rehab market, like I said, you want to bake in these comments into your strategy, at least until 2023, maybe 2024. Some of these projects maybe take a little bit longer to bring to fruition, and you definitely want to make sure that your long-term goals are your goals, and kind of pair that with what's happening in the market if you can, and try to be, a little bit more, just give it a little thought as to what you think best guess the market will be. If you're an investor, let me give an example. If you're an investor and you are considering doing a renovation or building a development, and this development is you bake into the cost of this development that your buyer can purchase this home at a 3% interest rate, and you can build this home at a certain price point. If you don't meet those goals, guess what? That's going to eat into your profit margin. If your profit margin is whatever it is, you're going to have to deduct that. And hopefully there's still some profit left. If you guess wrong, if you don't pay attention to what we're talking about, what the Fed chair is talking about, and the policies that's going on, you may not have a profit. You may be underwater. So you definitely want to make sure that you include all this as part of your overall strategy. And as I mentioned, when we get to the remarks section, a lot of guys that get up there and they're it's their time to be on national TV. They may have off-topic questions that we may not be interested in. So I'm not going to even cover that. Where do I see the market going in the next couple of months? Let's say this quarter into, let's say FY23, third quarter FY23 is exactly in line with what the Fed chair said. And I think that we, as investors, as captains of our home, we got to pay that a lot of attention. So, be informed, be ready for the changes in the market because it's coming. It's going to come in whether you're ready or not. And I want you, above all, to stay grinding. I'll see you guys on the next one.